Have you done some other courses around this topic? And you covered there a bit finance in the management course? Oh, you had finance management.
Yeah.
Okay. And but it's not so much about companies, it's more about your personal finance and investing and so on, or what is it about?
It's more close to company, not personal.
Okay, so you have a full course on this.
I don't know about others. That's my personal experience.
Okay. All right, then I hope that, yeah, it's not too boring for you. It's, as I said, it's not so much about the theory. We just have a few slides going through this theory, and then the biggest part will be actually setting up the finance plan for your company. So yeah, in this course, it's more about the practical and operative thing, not so much about the theory. Okay. In general, there are different financial documents in a company, and one of the most important one is the income statement. It basically describes the revenue and the expenses side. So when you start with on the top, you have the revenue, so all the money which you make with your company. And then you subtract from this revenue, you subtract the cost of goods sold, the COGS, they are called in short. Funny name if you spell it, if you pronounce it. But what does it mean, the cost of goods sold? It's all the costs which are related to selling your goods. So for example, if I have an e-commerce shop, and I'm selling fashion accessories, let's say. So you have the shipping cost which you need to pay. You have the product costs. You need to produce a product. You have the marketing costs, which are all in the cost of goods sold. So basically, all costs which you can connect with the actual sale. So you have the product you sell. You have the marketing budget beforehand so that the customer could go to your website and buy it. So it's all cost of goods sold. It's sometimes people, it's not that like set in the stone. It's still flexible what you can count to cost of goods sold and whatnot. But in general, you can remember like all the product, as the name says, all the costs which relates to the actual sale of the good is towards this category. Then the third term in the important term is the gross profit. So the gross profit is your revenue minus the cost of goods sold. And that gives you the gross profit. Then going from the gross profit, you have to subtract the operating expenses. And these are basically mostly all the fixed costs you have. So it's like the rent of your office. It's also the overhead costs, meaning the employees. It's your wage. It's some developing and innovation costs, research and development costs, and so on and so on. So basically all costs which you have to do, which are around selling your products. And if you subtract gross profit with the operating expenses, you get the EBIT, the earnings before interest and taxes. And this is most often mentioned number also when you look at public companies in the stock exchange, and so on. So this is basically your profit before you pay the taxes, and the net income. If you go on the bottom, right, the bottom, the net income is basically your profit after you paid all the taxes, after you paid all the interest rates, like interests to the bank. If you had some credit, for example, a loan, you have to pay the interest. So it's not so important that you like know for each of those terms what it actually is, but you really have to remember those 4 words. It's revenue, gross profit, earnings before interest and taxes, and net income. These are the most often stated KPIs or terms in the finance part. So if somebody asks you, hey, what's your revenue? I think that's very easy to tell this number. It's like all the turnover you made. If somebody asks you, hey, what is your EBIT? He basically wants to know how good is your company performing, right? Because companies can do a lot of revenue, but they can have a very negative EBIT, like Uber, for example, or like all those high growth companies. They do a lot of revenue, but they have also much more expenses, and then they will have a negative EBIT. And maybe last point, which is very important to mention, you can obviously also build some relative KPIs here. So you can say, what is your EBIT revenue share? So let's say if you make 100 euros revenue and your EBIT is 30 euros, then you have a 30% EBIT rate, EBIT share. So 30% is really good. So there are some benchmarks out there. It depends on the industry you're in. So if you are a software business, your EBIT margin is mostly higher. So it's maybe between 20 to 30%. And if you are like a consulting company or you're a trading company of hard goods, then your EBIT margin is more between 5 to 15% maybe. So it depends also a bit on the industry and the business model, but the higher the EBIT margin, the better, of course. And this is how a lot of people, or what maybe I can share my learning from my experience from startups is, you know, when you ask other founders, other entrepreneurs, hey, how big is your company? Then they are always saying, yeah, we make 2 million euros revenue, but they make 0% EBIT margin. So they don't make any profit. So I think my personal opinion is that EBIT always is better than revenue. So you should be very proud of you if you make a lot of EBIT, and if you do a lot of revenue, that does not tell you anything. Yeah, so much to this. Yeah, this is, I think you probably learned that then in your course. I don't want to go into too deep because I'm also not an expert in finance, but what is important here to know is that there's always 2 sides. So there's this balance sheet, and it's always 2 sides. So on the left side, you have the equity. The assets. So what you actually have. So your cash on the bank, all the machines you bought, so the fixed assets, so the things you actually own. And on the right side, you have the things you don't own. That could be some loans, debts, things you still need to pay. So for example, every month you need to pay the wages. So every month you have on the right side, you have the line wage payable, because you will need to pay this wage this month. So this is some liability to your employees or to banks or to other service providers. And yeah, this is just how basically the finance of companies looks like. But I think in your course you will learn much more about this. And where I want to go into a bit more deep into is the cash flow, because that's especially that's an essential part about startups, and also about high growth startups, is finding the cash flow, the break-even point, basically. So to explain you maybe a bit more the slide here. it's from a subscription business, this slide. This dotted line here, the dark blue one, which is dotted, that is the total revenue. The total revenue per month, I think, not sure. And this violet line here, it's a subscription revenue. It's meaning that every month there are people coming on top, right? So imagine Netflix. Every month they have 40 more users. So there are 40 more users who pay 10 euros more every month. So 400 euros more every month. And that's why the total revenue is growing here. So don't look too much on this line, just look on the total revenue line. And then you have the other dotted line of the violet color here. This is the total expense, right? So these are like all the costs. These are the costs of paying the wages, paying the rents, paying the expenses, the interest to bank, and paying taxes. So like total expenses, all the costs you have. And the bright blue one here, this is the cash outflow. So cash outflow means every month you, like the cash which you pay. So expenses and cash outflow is something different. Where the money go. Is that how you would describe cash, Ray?
Describe the cash flow.
Yeah, you can. It's a good.
Where the money goes and where the money come and where the money go.
Yeah, it's a good explanation, right? So the cash outflow is like the money you pay this month, but that does not mean that you have other expenses. So, for example, if you have to pay back the debt, or if you have to pay back some bigger things, but you don't have to pay it today, but maybe in 2 months, this is still a total expenses. So that's why you see here, the total expenses is higher, like you have more expenses than the actual cash outflow every month. And if you're now looking on those red points here, the CF means the cash flow break-even point. So the cash flow break-even point is where the cash outflow hits the total revenue line, meaning that every dollar you're getting in your company this month, you will also pay out. So at the end of the month, you basically end with €0 on the bank account. This is the break-even point, the cash flow break-even point. And this is the very crucial point in startups, because what does this point tells you? If you reach this break-even point, you are no longer in need of external financing. So you can basically live from your own revenue. So you don't need to get investors on board to pay you money to substitute the difference between outflow and the total revenue. Did you understand that? Or did you already know that? If you didn't understand that, I can do another example, or we will see it later in the template.
I can understand.
Cool.
We learned in the last semester.
Okay. Okay, but then you will see it later, if in case you didn't understand for the others, because before we go to the template, actually creating the finance plan, some more informations about how to actually get money for startups. Because in our case now, for example, where in the startup where I'm now, we have to get from
Wait. Do you still hear me?
Yes, but the sound seems a little different. What's wrong?
Oh, can you hear me?
Yeah,
Yeah.
I
Sorry,
can still hear you.
headphones went out of battery. Sorry. So in our case, we also need to raise some money. So we need to approach investors because we don't have so much revenue that we can pay all our costs, and we want to grow and so on. So here is basically the summary of the investment stages of startups. You have different stages. So the bigger you are, the more money you can obviously also get from investors. And maybe we start from the left bottom. On here you also have the stage of the startups. So you are now in the concept research phase, right? Because you're still looking for this problem, what you want to solve. You're still thinking how your solution can look like. And in here you can always, the funding round you're looking for is a seed stage. And next steps is angel investors, and you see the bubbles, they get bigger and bigger because there will be also more and more money put in your company, because it's always about the valuation of your company, right? So, and what is the valuation of your company is basically the meeting point between you and the investor. So when you want to give your investor 10% of your company, and your company is 100,000 euros worth, he will only pay you, or only in brackets, 10,000 euros. So this will not really help you to build the product and so on. So you will need to make sure that your arguments and the market size and everything is so big that you can say, hey, my startup is today already 1 million euros worth. So we get, for this 10%, you have to pay 100,000 euros, and then you can already start with that. So basically it's all about, and that is why we're doing also the validation work. The more you have validated, the more, the higher the valuation gets, because the investor sees, oh, there are already people who want this product. This will be successful, for example. Yeah, and the last thing I want to mention is cash is king. I don't know if you had this quote, but it's really, when I look at other startups, other companies, it's not so important how much revenue you make, or yeah, it's always important to still have cash on the bank. So that's why we're now focusing today on the cash flow planning, and we will set up now a table, Google Sheets together. Let's and I will actually start from scratch. Or have there been some questions for the slides? No? Okay. All right. So have you done such a cash flow table before? Okay. What do you think is the most important part for a cash flow table? Okay, so let's start. I always, or Ethan, do you have some comment?
No, just keep going.
Is, who wants to be the, who wants to offer his or her business model to make a test? We would already create the finance plan for this person, so it's a lot of benefits. Who wants to go? Who, like, which business model should we take? Okay, if you don't want to go, then I will just make something up. I will use a software business, which makes money on a monthly subscription fee. So there are brands, and they pay per month a subscription fee. And we are a software business, so we have to develop a software. We have to maintain the servers. We do a lot of marketing because we need to approach new customers, and we need to pay obviously all our employees and so on. For your better understanding, okay. So where would I start? Always on the good side, on the revenue side. So what I would do is now at every month. Let's see if, yeah, Excel makes this perfectly. So we will just do for 1 year, or maybe longer, we will see. But usually you do those cash flow plannings for, if you go in front of the investor, you do that for 3 to 5 years. If you're now actually in your startup and you're working in your startup, you do that more on the monthly or quarterly basis. But if you go in front of the investor, they always want to see a 3 to 5 years plan. Okay, so we start here with the revenue side. Let's make this center. So which revenues do we have in the software business? So we have this monthly, or we have amount of customers. We have the average monthly subscription fee. Why average? Because we have different plans. Imagine there are 3 plans. One is a light plan, one is the premium plan, and the third is the enterprise plan. I will actually the meaning of the hashtag is the number of customers. I can also write it like this. So like amount of customers, 1, 2, or 3, or how many customers you have. Okay, so I will then put here on the top the light plan costs 49 euros per month. The premium plan costs 199 euros per month. It's just random. And then the enterprise plan costs 999 euros per month. Maybe let's do the, let's keep it like that. So then we have to, of course, say here number of customers. I say here total, and then we of course have to say how many customers we have from the light plan, from the premium plan, and the enterprise plan. The pricing strategy. Thank you for all the questions, Ray. Very good. The question, the pricing is a topic for itself. It's a really complex topic. If you're interested, I can make a lecture around pricing. I think that will be actually very interesting. In this case here for the plan, it's just random. But you will see actually, maybe we will need to change the pricing a bit because we don't make enough revenue. So we will see. Maybe we will change them later. But for them now here, it's not really, it's completely random, the pricing. Okay. So we have the average monthly subscription. or no, let's say here not the average, because we already you will see the monthly subscription revenue. Okay, what else do we have? Imagine we have a software where we really just have an onboarding process. We don't have anything. We don't give any workshops, or we don't have any other revenue stream. So it's just really the monthly subscription. So let's see, let's put this on the top. And then, so the revenue side, revenue side, I think, is done. It's very easy, looks very easy. Okay, now we need to, let's do 1 month, then we will see. Okay, let's say we have November, right? So our goal is in January to have the first paying customer, or let's say 3 paying customers. So we will have 1 light plan customer, 1 premium plan, and 1 enterprise plan customer. So number of total customers is just the sum of those 3, right? And the monthly subscription revenue is light plan times 49 euros. And this one is, we need to make dollar signs there. So if we move the cell to the right or to the left, it does not change. Plus the premium plan times this 199 euros. Plus enterprise plan times the enterprise price. That's times, not plus. So we generated, in January, we have a revenue of 1,247 euros. So now it's a big question how we continue. Because we have here, either way we say how many new customers we're getting, or how many customers we have in total. So I would rather work with the added, the new customers. So number of new customers. And then this revenue here is just the let's say the added monthly subscription revenue. Because if we now say in February, we will get 2 light plan customers, we will get 3, and that's very random now. I will explain you later how you can measure this better. We will just move this here. And this here as well. So you see here now we have, if you look at the formula, that's correct. We made 2,000, almost 2,700 euros new bookings, so new revenue. And let's say we want to grow at the same pace as in February. So we are just copying the same numbers here. So now, starting from February on, we are growing every month. We are adding 2,000, almost 2,700 euros to our revenue. So we can say now the total monthly revenue is, in January, it's just 1,247. In February, it's the people who got customers from January plus who are new in February. And now we just do this plus this, and we move this here. So at the end, in December, we make every new month, and this is assumption, there are no customers leaving, of course. That is our assumption here. If in case, I mean, this is very usual in software business, you always have to calculate also with customers who churn, so who leave. So in this assumption here, these are only the netto, the new customers, and we are not worrying too much about the leaving customers at the moment. But in a real time, in a real scenario, you would also think about the customers who left you. But in this case now, if we go back to the this line here, we would make like every month we would make 30,000 euros now revenue. Okay. So and now we look at the cost side, the expenses. So we have the rent, the office rent, we have marketing budget, we have software licenses, we have like administration, like lawyers, accountant. We have server capacities. We have wages of, let's say, 5 employees. Here you can also, of course, do that more specifically. So write down each employee here in the line and then say how much they cost you. What else? Let's look at the slide here. Personal. Yeah, maybe like some office.
Electricity.
Yeah, this would be part of the office rent, I think.
Ah, okay.
Like everything connected to this. Also the printer and papers and so on. The plan is always promising, yeah. So office rent, let's say you would work with your 5 people, so you can work in a smaller office in, let's say, in China or in Frankfurt. In Frankfurt, you would probably pay, for 5 people, you would pay 1,000 euros per month. Then now you have to be more concrete in terms of the marketing budget. So imagine you want to acquire 3 customers in this month. So you need to have a website, you need to maybe spend some ad budget in Facebook or in LinkedIn or where your customers is. So you need to be, you need to go out there so that you're aware, that your customer is aware that you're existing. So let's say I'm always working with cost per customer. So let's say in B2B, because we have here a software in B2B, the customer acquisition cost of every, like how much does each new customer cost us? It's, let's say for this case here, it's 250 euros. Okay, so if we're gaining 3 new customers, we pay 3 times 250 euros. So we have a marketing budget of 250 euros. Yeah, how do I know the 250? It's also assumption, but you can find those assumptions if you Google benchmark customer acquisition cost. This is a term for it. Oh, wait, I found here a good. So look, now if you have a good, can be hard. Here are a few customer acquisition cost benchmarks across a variety of industries. So for example, marketing agencies, they pay around 141 euros per new customer. Real estate, telecom, technology, software, here you have even $400. So let's change that to $400. You always want to be higher than, like you want to have some safety bet, let's say. Okay. Here, of course, you can always you can tell a story around your numbers, right? Because imagine you're a startup and at the beginning you're not known, so you have to spend more marketing budget that people actually get to know you. But then, if you develop certain customers, they will also tell their friends, "Hey, look, that's really cool," and that is for free, right? So the average customer acquisition cost, in the best cases, if you do it right, they will decrease over time. So we can play with that a bit now. But here, software licenses, let's say it's 500 euros. It's for sales software. It's maybe for some marketing softwares. We pay 500 euros. Lawyer, accountant, every month we have to pay 1,000 euros. And server capacities is based on the usage of our software, right? Because if more and more people use our software, we need to have more capacities. So let's say that's also dependent on the customer, and this is really just an assumption here. We pay, now let's say we pay 500 euros here. And every new month, this grows for 5%. So it will be also increasing of around 5%. You can, yeah. Okay, and then 5 employees. So it's you, the founder. It's a marketing. It's a developer who develops the software. It's a sales guy, and maybe some back-end developer. So we have 5 people which are very experienced, let's say. So I guess
this must be quite expensive.
yeah. So let's just, this is just an assumption. Let's say they get 5,000 euros on average per month. So you have 5 employees times 5,000 euros, and here again, that's not the netto wage for the employees. It's the wage the company pays. So the company has to pay something on top of the netto amount. So always think about the cost of the company, not like the netto wage for the employees. Okay, so let's see. The marketing budget, we have a formula here, right? Software licenses also, it's not changing. So now we can just, let's see, we will change it here to euros. Oops. Or let's keep it in dollars. It's easier now. So we will just change it. So you see here, the marketing budget is increasing to 2,800 euros because now every month we're getting 7 people to it. So what we can say is, let's say after June, we do not pay 400 per customer, but we pay 350 because there are people who refer us, mouth-to-mouth marketing, and we have such a strong product that a lot of people recommend us, so that we don't need to spend too much ad spending. So this is the assumption, and then here the no reason. It's just we are 6 months in business, and so we collected 40 customers. So it's just a feeling, yeah. Okay, here we need to change it into dollars. Okay, so these are now the costs. So here I will make a last line of total expenses. And here also make a total, like a sum. Okay, so now you already see. Okay, no, I will show it to you now. So this is your income here, and that's your outflow of money, right? So now it's the $1 million question is, how does the cash flow look like? Because you know, you cannot pay more money than you have on your bank account. So what you do is, and that's just really usually there are much more lines here, like interest rates, like small fees to the bank, and so on. So taxes, of course, turnover tax, and so on. But it's now just a simpler version of it. So here we have the total monthly revenue in January, right? So this is our income, and we take it minus the total expenses in January. Oops, minus 28,000 euros. That's not good. So this we will do now for the whole year.
Only the last 3 months.
Correct. So here you see now the whole year is negative, 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 negative until December. Here we have the first month where we have the cash flow break-even point, right? Because here it's the first month, so this is basically the point, this point here, where the income is higher or the same as the expenses, right? So now it's a question, how do you survive the months until December, where you have big minus, the plan is not promising, yeah. Correct, but this is that's startup, and that's why there are investors out there and people who want to give you money. Because what you now need to calculate is actually how much investment do you need to reach December, right? Because in December, you will be able to live, let's say, on your own. You can live from your own revenue. But the question now is, how do you get to December? And that's very easy now. I make here cash needed. And I just do, in the first month, you are minus 28,000. And then in February, your bank account looks like minus 54. In March, your bank account looks like minus 78, and so on and so on. So I just move that until here. And you see here, this is the highest amount. If I mark this, that's the amount of money you need to get from the investor. You need to have 174,000 euros or dollars you need to get from the investor so that you can pay all your bills until December, until you reach your break-even point from which you can live on your own, let's say. Did you understand that?
Yeah, I understand, but this plan is not promising. It's frustrating.
Yeah, the thing is, it depends on your business model how such finance plan look like. Because, you know, if you're in software business, you will always need to develop your product before you actually get revenue. In case of, let's say, a restaurant or something, it's also, you need to invest marketing, you need to invest in wages, and in the first months probably, the restaurant is not so known yet that you actually make good revenue. So there will be always, it depends on the business model. If you are like an e-commerce company, yeah, you can make turnover on the first day because you sell products. But in software, you first need to build the software until you make revenue. And actually, if you look at really other startups and high growth startups, it looks all like this. They work. Imagine the finance table of Uber. I think it's just times like 10,000 the numbers. They make every month. They make millions of losses. Yeah, that's the startup life and the economy. We have so much money out there that investors are willing to invest into such growth companies. Yeah. Some other questions? Okay, so to sum it up, those business plans, server capacities. Yeah, if you are working in the cloud or if you have a software, you need to pay like servers, like where you host your software on, like Zoom. Now we are on Zoom. It's a lot of data, and Zoom has to pay for it. So that's why they have a lot of server capacity cost. Yeah. Okay, so to sum it up, such a finance plan is always built upon assumptions, right? As you saw that we say, okay, starting from July, the customer acquisition cost will be lower. We will have this wage of people and so on. And the more, of course, facts you already have, the better. But usually those finance plans are always built upon assumptions. And those assumptions, they need to make sense. And if they tell a good story, it's good for investors. They will believe you. For example, what we could still do here is say, hey, okay, this looks not really good, not promising. Let's just change, and I'm really curious to see what happens. Let's change the pricing, because pricing is has the biggest influence on the profit and on the revenue side. So let's say the light plan costs 199 euros. And the premium plan costs 499, and the enterprise plan costs 1,499. Then you see that the break-even point is already in July. Hey, and we only need 96,000 euros from the investor. So much less than before, right? So this is very nice. If you have such a template, you can play around with it, and you can, it's also very good to always have different scenarios. So you have a good case, like worst case scenario, best case scenario, and then something in the middle. So for example, COVID-19 is like the worst case scenario probably now. But like that, you can build up on certain scenarios and then see, yeah, what you can do in them. Okay, yeah, I wanted to show you those dynamics, and please have a look, prepare one of your plans on your own. I can only recommend you look in the internet for some templates. There are a lot of templates for those cash flow plans. You don't have to build them on your own. There are sometimes very complicated ones out there. So either you take the complicated ones and you just delete all the stuff you you don't need. For the beginning, I would say it's enough to have such a overview. So it's like a rough calculation. It's like, this is not a business plan here you would be able to present to investors. It would need to be more concrete. We need to establish more the arguments behind our assumptions. We would need to do this for 3 years. We would need to showcase also how much money the investor makes in the future, because that's why he's investing in your company. But this is just now for the first quick calculation for you. And please, test it out for yourself. Test it out with your assumptions. I think you all have different business models, so it will be interesting to see what kind of revenue streams, what kind of costs each of you have. So please continue validating your hypothesis and prepare such a cash flow Excel file. This will be also part of your project report in January. So as more you do already now, the less you have to do later. I guess.
Sorry, but you know, I don't have much experience in finding a new kind of business like my project plan. How could I find an example like or maybe some close business like my project?
How you come up with a finance plan, you mean?
Yes, as a new startup in a new area.
Just feeling.
It's not because.
Do you know Ströer?
Yeah.
They do all the advertising in the train stations on the displays, right?
Yes.
So, I mean, at the end, you have the same business model like they do, right? You just have a different display place. So they showcasing the advertising in the train station, and you showcasing the advertising in the tunnel. But at the end, it's the same business case. I think, at least. I think it's not something from the business side. It's not something completely new. So here again, you just need to be sure what is your revenue. So let's make an example. Imagine your paying customer are the brands. Yeah. So you have, let's say, the number of run campaigns. So the campaigns are the brands, they pay you to run a campaign on your screen. And the average price per campaign is, let's say, 10,000 euros. And in the first, let's say here is January, in the first month you have 1 customer. In the second you have 2, 3, and so on. And then you just calculate the price times amount of campaigns you run. This could be one example. The other example could be
because you know the advertising internal is time limited. So if you let the first one get in and he paid, as you see, 10,000 euro, he just take all the time. If he take all the time, then where is the next? It seems a little complex.
Yeah, but then that's just you have to figure out the assumption. So you can also say one campaign, or let's not say campaign, but let's say amount of advertising minutes sold. So you can say the price per minute is, I don't know, 100 euros. So in the first months, you will have, let's say, 2 brands, and they are willing to showcase their campaign for 200 minutes on your screens in the tunnel.
Mm-hmm.
So your revenue will be, your revenue will be 200 times 100 euros, 20,000 euros. Okay, and then you say, okay, the other minutes where we don't have advertising, I will showcase some news, I will showcase some funny videos, but they are not paid. And then in the second month, you say, hey, I got more customers and I have sold 500 minutes. So your turnover in February will be 50,000 euros. So it all depends on your business model. That's why I said you need to focus now more on the either the customers who pay you money and not so much about the commuters, like not so much about the people sitting in the tram.
Okay.
But maybe you can find out like the price per minute, how much is it a benchmark, maybe like look at the maybe TV advertising, how much does a minute cost there? And you can find some benchmarks. Where can we find reference value? Yeah, it's about looking in the internet. Google knows everything. I would just look up some like benchmark number for, and then the one you want to find out. All right, cool. Yeah, can we find benchmark? Yeah, that's what I said. If you type in, I don't know, cash flow plan template, Excel, you will find a lot of spreadsheets and templates you can just use. No problem. I always use templates for that. Yeah, from my side, that would be all. We are a bit earlier today. If you don't have any other question, then we will hear us next week. Financial statements of listed companies. Yes, sure, you have them. For example, Ströer or Ethan, you can look them up. Look like it's here, investor relations, and then maybe Halbjahresmitteilung. So they need to, if they are publicly listed, they have to publish their numbers. And Ströer is publicly listed on the yeah, look here, some of the first half year, the PDF, all the numbers in turnover. Yeah, here you could get really interesting numbers, Ethan, from direct media and so on. Here you see the EBITDA, the one, they make a lot of profit here.
For sure.
Yeah. Okay.
Thanks.
Cool. Then thanks for your attention and see you next week.